Everybody, Mike DeSepoli, Heritage Financial Advisory Group. Welcome to the Heritage Market Update for Tuesday, April 26, 2022. We hope your week is off to a great start. Just a really tough day today in the markets, coming on the backs of a tough day yesterday. So we want to come back and update you on our view on the markets. We know this is a very stressful time, an emotionally taxing time for investors. So we hope to share our views with you, provide some perspective on where this market is, how this could play out, and ultimately where it can go from here. Just looking at the major market averages today, a lot of red across the board. It's not often you see the Dow Jones down by 809 points, the S&P off by 120, and the NASDAQ down by 514 points. Now, folks, as bad as these numbers look on the surface, this is the type of activity that we need to put this downturn behind us. Okay, corrections, downturns, they all end the same way, with a selling climax, with total capitulation of retail investors, right? It's the test as old as time. It happens every time. Now, the hallmarks of that capitulation, we'll go through a couple of them here today. We think we're starting to see a couple of the signs forming. And I know it sounds, you're probably thinking, well, Mike, why? If we want the market to go up again, why are we rooting for it to go down before it goes up? Because, folks, what you need to happen is the market needs to lean on people, and it gets enough people to fold their hand at the bottom, create a selling climax, and that is where support will form and buyers will step in. Are we there yet? We're going to find out soon. We're certainly going to find out soon. So let's take a look at the market. We'll start with the NASDAQ. We'll zoom in. Okay. So here we are. We'll put some very important areas and critical lines on the chart. So we know about the 14.5 level, right? We spoke about this at length. We did point out at the point basically about a month ago on April 4th when the market was unable to successfully get through this resistance and turn it in support. We had said at that time that a retest of the lower end of the range was likely. So one of the questions we've gotten, rightfully so, is folks have asked, but Mike, if you felt that we were going to go lower off the resistance point, then why didn't we sell everything here and buy it back down here? A fair question, but what I need to point out to you is when you have a resistance point that you fail upon, there's no guarantee you go back to the lower channel, the lower end of the channel, right? This correction could have turned around here, or here. But unfortunately, the weight of the market, the news flow, and some of the earnings that we've seen, even though the earnings have been good, the reaction to them has not been as good. It's put a lot of pressure on the market. So here we are, still within the same range that we've been in for 3 months. Now, we had an interesting development today on the NASDAQ where the NASDAQ went slightly below the lows that we saw from February and March. It is a different story when we look at the S&P. The S&P is still hovering above those lows, okay? So just some divergence to note there. But basically, folks, the charts look the same if you overlay all the major indexes on each other, right? We have a market in correction that has tried to rally unsuccessfully a couple times. Now, do not be discouraged by failed breakouts, okay? In the market, sometimes it takes 3 or 4 cracks at a level to actually get through it. Now, obviously, we came into this one pretty swiftly, and buyers just ran out of steam at the wrong time. So when we look at today's activity, we see a lot of red across the board, right? There's very little positives to shed light on here. However, another thing we want to convey to you is when we're talking about downturns, right, and we're talking about market corrections, they tend to work in sequences, right? So to use a war analogy, okay, the beginning part of a correction, they come for the infantry. The later stages, the ending stages of the corrections, they come for the generals. Now, the generals, to relate it to the market, are the fan favorites, the mighty few behemoth stocks, if you will, right? Apple, Microsoft, Google, Amazon, Tesla, and we could add a couple more to that list, right? But these are the fan favorites. These are the most widely known stocks. And what we're seeing now over the last 2 weeks that we haven't seen over the last 6 months is these stocks are starting to break down. Now, again, sounds like a bad thing. But folks, for corrections to end, we need to move through all stages of the correction. And we had some pause and some concern as we were going through the early parts of the correction that these stocks were not seeing the pain that they should during a market pullback. Now, we are never rooting for downside, but we have to take these market moves as we come. We have to be flexible, to be reactive to the market, and to judge the data based on what it is telling us. And what we see now is that these were the lone holdovers, the stocks that held up. And really, this is why some of the major market averages had held up as well as they had until recently, because now the sellers are coming for the mighty few. And again, it may not feel like a good thing, but this is usually something that happens at the later stages of corrections. But, I think today what we need to talk about is perspective, right? We need to zoom out. In the investment management business and as investors, we know we all get sucked into zooming in and staring at the here and the now and obsessing over every little move in the market. And obviously here at Heritage, our job is to be with our eyes on the road at all times and evaluate every move in the market. But sometimes when times get tough, we need to zoom out and remember, number one, that markets go higher over time. Number two, there has never been a pullback or a correction in the market that was not followed by new all-time highs. So maybe this is the one time where the experiment of America is going to come to an end and capitalism as we know it is going to die on the vine. But I don't think that's going to be the case, and I'm sure you don't either. So we can expect at some point in the future that markets will make new all-time highs again. So let's worst case it here for you, okay? Because I've had a few questions recently that asked me, Mike, if you could give me the worst case scenario here, right? What do you think could be the maximum downside? Where could this correction end? Where could markets turn? Well, we've certainly made a few valiant efforts, right, for the market to bounce. And unfortunately, we've just run out of momentum. And some of that has been negative news flow that's just hitting the market at a very important time, right? We had pretty good news flow coming up into the short-term high we made on April 4th. And then all of a sudden, sentiment started to shift, and all it took was a couple down days, and then it fueled the narrative that the market failed at a critical resistance point and was going lower. So basically, as soon as you went from here to here, all the buyers disappeared, including ourselves, right? If you've watched the activity in the portfolio, we've been patient, and we're sitting on our hands. That's not for a lack of knowing what to do. Sometimes the best part, or the only thing, the best action, I should say, is doing nothing, right? Investing is 10% doing and 90% waiting, okay? So we're not going to force entries. We're going to be very patient with how we deploy capital. But when we zoom out and we look at the market, we say, okay, the market started a new trend in March of 2020, and it's come a very, very long way, right? The market basically was up from, let's call it, 2,100 on the S&P to about 4,800, right? So it more than doubled off the March low. So pullbacks are normal, and they are to be expected, right? Say it with me. Pullbacks are normal, and they are to be expected. Now, nobody knows when a pullback is going to start. Not us, not you, not any of the largest investment banking firms in the world. It's what you do once they start that will determine how your portfolio performs in the near term and the long term. So at the point that the correction began and we knew that there was some selling pressure in the market, we started to carve out some levels that would be critical to watch and some potential maximum downside scenarios. Now, to move it, let's zoom in just a little bit more. Oh, that ain't going to work. Okay. So what we think you're probably looking at it as a maximum downside scenario would be 4,000 on the S&P 500, okay? 4,000. So what that would look like from here, we're about 4175, okay? So folks, if this holds true, most of the damage has already been done, right? So I mentioned this because it begs the question a lot of people ask is, maybe I should just leave the market, right? Maybe I should get out. This is not for me. We're losing money. 2022 is not a good year. Well, folks, the market has had a good run for many years in a row. Markets need to consolidate. They need to pull back. They need to breathe. They need to work off some of the excesses and froth in the system. So where we're at right now Zoom in a little bit more. Okay, oh, that's not going to do the trick. So the markets have come a long way and we're pulling back. Now, when you look at a market that has moved up 150% off the lows of March of 2020, folks, it would be totally normal and within the realm of possibilities to have a 25% pullback and still be in an uptrend. I know that sounds hard to believe because we all like to live point to point, and all everybody's focusing on right now is that the market is down since the start of the year. Absolutely right. It is down since the start of the year. But if you've been an investor who's been in the game for 2 years, 3 years, 5 years, 8 years, 10 years, etc., number one, you've been through this before. And number two, you've made a lot of money over the last couple of years. So this is part of the game that we have to do our best to control our emotions when times like this get difficult. We know the feelings that you're going through. We know that sometimes that urge inside you says, I just need to do something. But remember, when you're on an airplane and there's turbulence, the captain doesn't tell you to get up out of your seat and run around. They tell you to sit down and buckle up. And markets are no different, folks. And I'm not trying to give you a directive here, just a little bit of tough love that we understand the emotions that are running through you right now. But this is not our first time in this saddle. This is not our first rodeo. This is not our first correction. And I hate to break it to you, this is not going to be our last one either. This is just part of markets. These are not malfunctions in the market. This is a function of the market. So all we can do in times like this is continually hone in on what we own, why we own it, evaluate it from a fundamental and a financial standpoint to make sure the companies are still doing the things that they need to do and the reasons why we bought them, that they still have good addressable markets, and they still have products and services that are desired by the masses. And I believe that to be the case. Sometimes markets discount the future, they give up on growth, they tend to tune out their focus on what the future could be because all they can see right now is the 6 inches in front of their face. That doesn't make for a good investing strategy. So please, if you have concerns, if you have questions, give us a call. We're here to take each and every one of your calls, talk to you about the things that are on your mind. This has been a very trying time for investors, but good investors are made in difficult environments, and it's what we do today that will determine our success tomorrow, next week, next month, and next year. So reach out to me with any questions you have. Thanks for tuning in. We'll see you back later this week for the Heritage Market Pulse.